Hey everybody, back with another dividend analysis, and today we're going to be looking at the Kroger company, or simply Kroger, ticker KR. Going to be doing Kroger because a lot of people have been saying how much they like Kroger, and it's been in the news recently with a lot of big name purchases, so maybe we can get a decent company with a dividend here. As always, we'll start with the yield currently sitting at just above 2% at about 2.12%. Definitely nothing to write home about. I mean, you are doing better than the wide market, doing better than the S&P as a whole, but 2% is really around the minimum of what something needs to be a dividend stock in my opinion. So, right at that minimum here. Going back over the dividend history, we can see that in 2013 we would have been getting 15 cents a share, while currently we're getting 21 cents a share. So about a 33% increase in the dividend, which, over 10 years, it's not a lot, but it's okay. However, we do need to be careful in that about what is this? 2015, we had a drop in shares by about half, going from 21 cents down to 10.5 cents. I have not looked at why this was. I'm not sure why this has happened, but do make sure that you research this, find out why this happened. What it is exactly half the price. So was it a share split or was it something else? Check that. Make sure that this wasn't a drop because of the company having money issues or something of that nature. It is interesting to note that they did have a special dividend in 2018 where they paid out 45 cents a share, or a little over 3 times what the dividend was at that time. So that means they had a lot of extra cash lying around at that time. So that's nice to see. So maybe this was something like a share split or something of that nature. Just be sure to check that out. Now, let's see if they can afford to pay that 21 cents a share right now based on their financials. Going over to the cash flow, we can see that in the last roughly year, they did just under 4.5 billion in cash flow. Very nice there. And as we can see, they have been increasing their cash flow amazingly over the last 5 years, almost 9 times, going from 560 million 5 years ago to 4.5 billion this year, with a massive jump over each of the last 2 years, including over doubling it in the last year. Now, if they keep paying this 21-cent dividend over the next 12 months, that means that they'll be paying out about $625 million in dividends. And if we do our ratio of free cash flow here, we can see that they're only paying about 14% of their free cash flow out as dividends. That means that they could afford to take a huge hit in their free cash flow. Really, they could afford to drop back down to this number 2 years ago, 1.22 billion, and they'd still be only at a little over 50%. What does that mean for them? That means they could afford to raise that dividend. They could afford to pay off any of their debt. They could afford to, buy back shares, reinvest in the business. Their dividend payment doesn't really make that much of an impact on their cash flow at only 14%. So that's very good to see. Moving over to their income statement, we can check out the profits. And we have $2.5 billion in net income over the last year. Looking back over the income over the last 5 years, we can see that it is up a little bit, about 25% over the last 5 years. That's about 5% year over year. So not bad there, but we did have a big year in 2019 we have dropped back down from last year, 2020, probably something that can be understood due to the economic environment, and bouncing back from that now. So I just want to, if I was looking at this, I'd want to make sure that this income is going to keep going back up, that, this bounce back isn't a one-time thing, that the company's getting back into the way that things should be, things of that nature. If we do our ratio of income, we can see that just about 24% of our income is used to pay out the dividends. So that means about a quarter of the income being used for dividends, well under that 50% ideal range. Again, their income could drop back down to this number of 1.64 billion, and they'd still easily be able to pay out that dividend. Just keep in mind that we do want to see that income keep increasing. If it goes back down to that 1.5 billion and then keeps dropping, we'll have an issue. But currently, no problems in paying the dividend in terms of income. So what should we be looking at for Kroger for those things to occur? Pretty sure everybody knows Kroger is a grocer. They have supermarkets, grocery stores, things of that nature. As long as they're able to, sell their products in their stores, they should do fine. Things to look at, of course, with something like this is consumer sentiment, the wide economy. Since it is a grocery chain as opposed to another retail chain, they will always be able to sell. It's just a matter of will they be able to sell enough. Of course, since it's a grocery store, they're going to have very low margins. If there are any kind of economic issues, their higher margin items probably won't sell as well because people will just go to the basics, whatever they need to survive in case of an economic downturn. You're definitely going to want to look at their competitors, see how other grocery stores are doing. Again, consumer sentiment, how people feel about the economy is definitely going to matter for a supermarket, for a food retailer, any company of that nature. So, should you be looking at Kroger? Is this something you want to have? They have, they do have appreciation over the last few years. Again, I want to look at that dividend cut, see what the reason for that was. Was it just a stock split because it was exactly half, or did they have some financial issues? If it's the former, not really a big deal at all. If it's the latter, definitely something to think about. There is an okay amount of growth, but still. Let's say this was a stock split. That means that the dividend has doubled in the last 5 years. That's not bad at all. This could be something to look at, and it is, sort of a consumer staple in the fact that it is a grocery store chain. So there's definitely something there for an appreciation investor, and that this is something that if they keep increasing their dividend, it's also very unlikely that they're going to go out of business outside of weird mismanagement or the economy doing something that wasn't expected. From an income perspective, there's not a lot here. At 2%, there's just lots of companies where you can get a much better yield for, even for a grocery store, but just any company at all. 2% is really the very bottom of dividend stocks. If you're really looking for an income portfolio, I think you can find companies that are just as safe with quite a higher yield, probably anywhere from 1.5 to 2.5 times the yield. So I'd probably not look at this from an income perspective, but again, that's up to you. Now, looking at the company, is it really something you want to buy right now? Looking at the PE, sitting at about 26. Kroger is 150 years old. It's a very large company. It's in the S&P 500. The last year, the growth in the last year, and the income and the free cash flow is because of extenuating circumstances. The way that the economy was shut down. Many of its competitors were not able to operate because there were places that sold things that they sold but weren't considered grocery stores, so they shut down. So people had to go to Kroger and other big grocery stores. So that would have inflated their numbers quite a bit. If we are in the bubble that a lot of people think we are right now, this is something. While not going out of business, I could definitely see that stock price getting cut in half without really much of an issue. And getting cut from 26 in half would get to about 13, which is probably about where a large cap grocery store should sit. So if you're looking at this, unless you think there's going to be a lot more growth in this over the next few months to a year, as we can see here from the chart, it's down quite a bit from its highs, 20%. Unless you think this is going to jump back up over $45, $50. For the yield, there's just better choices out there. I'd wait. It's not a bad company by any means, but it's just one of those things where I would wait to see what's going to happen, try to get it at a cheaper price, try to get a better yield on cost, things of that nature. As always, I hope this helps, and thanks for watching.